What you are looking at right now is not a market correction. It is not profit taking. It is not technical selling at resistance. What happened today in the silver market is a precision engineered financial operation executed against retail traders with military level coordination, and the proof is hiding in plain sight inside the timestamps, if you know how to read them. The United States just deployed a second aircraft carrier strike group toward the Strait of Hormuz. Iran is conducting active military drills in the exact waterway that controls 21% of the entire global oil supply. Geneva diplomatic talks have stalled. War risk insurance on tankers has increased by 700% since January, and silver, the metal that goes into every missile guidance system, every electronic warfare suite, every radar array on every F-35 that just got scrambled to the Persian Gulf, that metal dropped over $3 in a single session today. If that sequence of events makes sense to you, you are either not paying attention or you're on the wrong side of this trade. Because the same institutions that moved their positions overnight before the news broke, the same desks that were selling large block trades at 3 times normal volume at 11:47 last night before a single headline had been published, they are counting on you to see war news and panic sell your position into their waiting buy orders at the exact bottom they engineered. Before we go any further, if this analysis is connecting the dots that mainstream financial media is paid to leave disconnected, hit that like button right now. Subscribe to this channel and press the notification bell, because what we are tracking in real time right now is moving fast, and you need to be ahead of it, not reacting to it. Share this video with anyone holding silver, gold, or energy positions, because the information I'm about to lay out on the mechanics of today's move could be the difference between understanding the setup and becoming part of the exit liquidity for someone who understood it before you did. Now let me show you exactly what happened and why the timing tells you everything. Let us start with the sequence, because the sequence is the evidence. At 11:47 last night Eastern Time, silver futures started moving. Not dramatically, just 60 cents. But the volume was the tell. 3 times normal overnight trading volume. Someone was selling large institutional block trades, 50 contracts at a time, 100 contracts, 200 contracts, all hitting the bid simultaneously, all driving price incrementally lower. This is not a retail trader in his home office panic selling his 10 contracts because he read a bad headline. This is coordinated institutional selling executed in the overnight session specifically because liquidity is thinnest, and each sell order has maximum price impact with minimum capital deployed. By 3 in the morning Eastern Time, silver had touched 76.20. By 6:30, it was at 74.50. And then at 9:35 in the morning, exactly 5 minutes after New York markets opened, every major financial outlet simultaneously published the same story. United States deploying the USS Gerald R. Ford Carrier Strike Group to the Middle East. Iran conducting military exercises in the Strait of Hormuz. Geneva talks stalling. The headlines were coordinated. The timing was not accidental. Military public affairs operations send press releases to major outlets under embargo, meaning they provide the information early with instructions not to publish until a specific time. The people who received those phone calls from the Pentagon and State Department 12 hours before you saw the headline used that window to position short silver, long defense contractors, long oil. By the time you saw the breaking news alert on your phone, the profitable side of that trade was already closed. Here's the mechanism that extracts billions from retail traders in a single session and why it works with such devastating consistency. Silver was trading at $78. Institutional players with advanced knowledge of the news embargo begin selling overnight at 78. The price drops to 76. Retail traders who went to sleep with silver at 78 wake up to see it at 76 and hold their positions, assuming the dip is temporary. The carrier deployment headline breaks at 9:35. Retail traders, operating on the logical but completely incorrect assumption that war news means buy precious metals, rush in to purchase silver at 76. They are buying from the institutional sellers who entered at 78. Then the margin call cascade begins. Traders who entered long positions at $80, $79, $78 are now underwater. Their brokers automatically liquidate positions when equity falls below maintenance margin requirements. That forced selling pushes price from 76 to 74. More margin calls trigger. More forced selling. The cascade accelerates. Silver touches 72.50, which happens to be the 38.2% Fibonacci retracement from the December 2025 low of $62 to the February 3rd high of $84. At that exact level, algorithmic buying systems programmed to respond to technical support kick in automatically. Silver bounces from 72.50 back to 74.83 in under 4 hours. At 72, the institutions that sold at 78 are buying back the same ounces they sold $6 higher. The math on that round-trip operation against 183,000 open contracts is straightforward. Each dollar move on a COMEX silver futures contract is $5,000. A $6 round trip is $30,000 per contract. Multiplied across 183,000 contracts, that operation extracted hundreds of billions from the market in a single session. The retail traders who bought the dip at 76 are now selling at 72 to cut their losses. The institutions buying at 72 will sell again when the war premium eventually kicks in and price spikes to 95. The retail crowd will buy again at 90. The cycle repeats with mechanical efficiency every single time the setup conditions align. Now let us talk about why this setup is genuinely different from previous manipulation episodes, and why the consequences if the geopolitical situation escalates are unlike anything the precious metals market has experienced in modern times. The USS Gerald R. Ford Carrier Strike Group is not just a ship, it is 11 vessels. The carrier itself, 2 guided missile cruisers, 2 guided missile destroyers, 1 frigate, 2 Los Angeles-class submarines the public knows about, and almost certainly 1 Virginia-class operating in silent mode, plus supply ships and support craft. The annual operating cost of a single carrier strike group is $6.5 million per day, not including aircraft, munitions, or fuel for sustained combat operations. Deploying a second group means committing $13 million per day minimum just to keep assets in theater. The United States does not commit that level of daily expenditure to a theater unless there is genuine operational planning behind it. Iran understands the difference between a show of force and a combat deployment. They have been preparing for this exact scenario since the 2020 Soleimani assassination, and their current military activities in the Strait of Hormuz are not exercises. They are drills. That distinction matters precisely in military language. Exercises are training scenarios. Drills are rehearsals of specific operational plans. Iran is practicing swarm attacks with fast attack craft against exactly the carrier strike group configuration now moving toward them. They are testing anti-ship cruise missile batteries on Qeshm Island. They are running submarine operations in the shallow water areas where American sonar systems have historically had tracking difficulties. This is preparation for kinetic conflict, and the insurance market is confirming it before the media will. War risk insurance premiums for very large crude carriers transiting the Strait of Hormuz have increased from 0.12% of cargo value in January to 0.85% right now. That is a 7-fold increase in under 6 weeks. When that premium reaches 2%, tankers stop going through the strait voluntarily. The financial math of the insurance cost exceeds the commercial benefit of the shorter route. When tankers stop transiting, 21% of global oil supply gets cut off from its primary delivery route. That rerouting around Africa adds 12 days to each delivery journey and $600,000 per tanker in additional fuel costs. When 21% of global oil supply gets rerouted, oil goes to $150 per barrel. When oil hits 150, inflation returns faster and harder than the 2021 to 2022 episode. When inflation returns at that velocity, the Federal Reserve faces an impossible choice: raise rates aggressively and collapse a debt servicing structure that already costs $1.2 trillion per year in interest payments, or hold rates and watch the purchasing power of the dollar collapse. There is no third option that does not produce severe financial pain for ordinary people. Every government in history that has faced this exact choice has eventually chosen inflation because it is politically easier. You can blame price increases on supply chains, on corporate greed, on foreign adversaries, on anything except the actual cause, which is the arithmetic of debt that cannot be serviced without monetary expansion. Here's what the U.S. debt situation actually looks like without the political packaging. National debt was $28 trillion in 2020. It is $36.4 trillion today. $8 trillion added in 6 years. The Federal Reserve printed $4.8 trillion between 2020 and 2022, expanding M2 money supply by 40% in 24 months. When you increase the supply of money by 40% while the supply of goods and services grows at 2 to 3%, prices must increase by roughly the difference. That is not ideology, that is arithmetic. The annual interest payment on the current debt in fiscal year 2025 was $1.2 trillion. That is more than the entire defense budget, more than Medicare, more than Social Security. The United States is paying more to service the interest on past borrowing than it spends on any single actual government function. And that number gets larger every year as existing debt rolls over at current higher rates, and new deficits require new borrowing. The people who tell you the situation is manageable are either not doing the math or are being paid to tell you it is manageable. Now let me give you the specific COMEX data because these numbers contain a signal that institutional players understand and retail investors almost universally do not. COMEX silver futures open interest as of yesterday's close was 183,422 contracts. Each contract represents 5,000 ounces of silver. That totals 917 million ounces of silver represented in paper contract form. Now look at COMEX registered inventory, the physical silver certified and actually available for delivery against those paper contracts. The most recent report showed 48.3 million ounces in the registered category. That means there are 19 paper claims for every single physical ounce available for delivery, 19 to 1. That is not a market functioning on supply and demand principles. It is a leveraged paper system that manufactures the appearance of unlimited silver availability through the creation of futures contracts that almost nobody intends to settle with physical metal. The entire architecture depends on the assumption that at most 4 to 5% of contract holders will ever demand physical delivery. The moment that percentage increases meaningfully, the system cannot deliver and the paper price becomes a complete fiction disconnected from the physical reality of what silver actually costs to acquire and hold. The physical market is already telling you this is happening. American Silver Eagles at dealers today are at $82.50 per ounce. COMEX paper price is $74.83. That $7.67 premium is not normal supply chain friction. It is a structural breakdown in the relationship between paper price discovery and physical supply availability. This divergence was last seen at comparable levels in March 2020, when COMEX futures crashed to $11.77 while physical silver simultaneously sold for $18 to $20 at dealers. The paper price was a complete fiction then. It is becoming a fiction again now, at far higher prices and under far more structurally dangerous supply conditions. U.S. Mint Silver Eagle production was 3.8 million coins in January 2026, compared to 5.2 million in January 2024. Production is declining in a straight line while physical demand is spiking. Dealers are reporting waiting lists. You do not get waiting lists for standard bullion products unless structural shortage has developed at the supply chain level. The 60 to 90-day production lag between refiner silver purchases and finished coins reaching dealers means the coins on shelves today were purchased when spot was $68. Dealers who stocked at those prices are now selling into a market where the paper price is $74 and physical demand justifies $82. If paper price moves to $85 on a Strait of Hormuz incident, some dealers will face negative margins on every coin sold from existing inventory. The technical picture confirms we are in a deliberate shakeout pattern ahead of the next directional move. The touch of $72.50 overnight was not random price action. It was the precise 38.2% Fibonacci retracement of the entire December to February rally, and it held exactly. The bounce from that level was algorithmic, not fundamental. High-frequency trading systems executed predetermined buy orders at that technical level because that is what they are programmed to do. Those algorithms cannot account for force majeure. They cannot price the probability of the Strait of Hormuz being closed by Iranian naval mines. They cannot calculate the impact of a U.S. destroyer taking an anti-ship cruise missile hit and what that does to oil insurance markets in the following 48 hours. Their models are backward-looking by design, and there is no historical data set that covers a scenario where two U.S. carrier groups are simultaneously within strike range of a country that has been drilling swarm attack tactics for 4 years. The machines bought the Fibonacci level. Humans with access to actual intelligence assessments are positioning for something the models have never had to price. Here is what to watch in the next 48 to 72 hours. Tanker insurance rates are the leading indicator, 0.85% currently. When it crosses 2%, watch for voluntary rerouting announcements from major shipping companies. That is the earliest visible market confirmation of effective strait closure before any official military announcement. COMEX daily inventory reports publish at 4 in the afternoon Eastern Time. Large withdrawals from the registered category mean institutional players are demanding physical delivery and exiting paper exposure. That is the most unambiguous bullish signal available in this market. Physical dealer premiums are currently at $7 over spot. When they reach $12 to $15, retail panic buying has begun and supply chains are entering genuine stress. Watch the Geneva talks. Both sides walking away publicly with no agreed resumption date removes the last diplomatic exit from a configuration where both sides have maximum military assets in position and domestic political pressure to project strength. The historical precedent for that configuration ending without kinetic conflict is essentially non-existent. Base case scenario with a 40% probability. U.S. conducts limited precision strikes on Iranian nuclear facilities within the next 30 days. Iran responds by activating proxy forces, threatening tanker traffic, and conducting targeted attacks on Gulf infrastructure. Oil spikes to $140. Silver hits 95 within 60 days as war premium and inflation premium compound. Physical premiums expand to $15 to $20. COMEX faces another delivery crisis and changes rules to protect the short side. Fed cuts rates into rising inflation to keep debt serviceable, beginning the dollar debasement acceleration. Alternate scenario with 30% probability. Geneva framework is reached. Military assets stand down. Oil falls to 85. Silver corrects to 65 as war premium unwinds. This becomes the single greatest accumulation opportunity of the decade for anyone who understands that the debt is still unsustainable, the currency is still being debased, and the COMEX paper to physical ratio has not been resolved. Muddle through scenario with 30% probability. Neither escalation nor resolution. Standoff continues. Silver trades 72 to 80 in a volatile range for weeks. Physical premium stays elevated. Uncertainty persists. The structural setup deteriorates further with each passing week of unresolved tension. Regardless of which scenario plays out, the strategic position is identical because the underlying structural problems do not resolve in any of the three scenarios. Accumulate physical silver below $80. Accumulate physical gold below $3,500. Hold dollars only in the amount required for immediate operational expenses because every dollar held beyond that is losing 7 to 10% in real purchasing power annually, regardless of what the official Consumer Price Index reports. The CPI was recalculated in 1990 using a methodology designed to show lower inflation than the previous methodology produced. If you applied the 1980 calculation methodology to 2021 to 2022 price levels, actual inflation was 15 to 18%, not the 7% that was reported. The same structural distortion is in place today. Your cost of living is increasing faster than official statistics acknowledge. Physical metal held in your possession, outside the paper financial system, outside the COMEX delivery apparatus where 19 claims exist for every physical ounce, is the historically proven mechanism for preserving purchasing power through exactly this type of monetary and geopolitical convergence. When the first confirmed military action occurs in the Strait, you will not be purchasing silver at a reasonable premium. You will be on a waiting list. The people who are right about direction but do not act before the catalyst are in the same financial position as the people who were completely wrong. History rewards preparation, not analysis after the fact.